Mahesh Nandurkar is joining us at this point. He's Executive Director at CLSA India. Mahesh, thanks very much for your time. Great to have you with us here. First up, let me wish you, your family, your team a very happy 2016. Thanks for coming on today. I want to start with the basic, simple question. What's your outlook for stock markets in 2016 after a kind of subdued 2015?
Hi Prashant, thank you very much for inviting me and wish you and your viewers a very happy 2016. So the outlook for equities, the 2015 calendar year that just went by, hasn't been particularly good. After a long time we saw negative returns. But my sense is that the outlook for 2016 remains more optimistic. The reason why I say that is there are two specific reasons. One is that the economy is clearly now showing signs of improvement. And if you look at various high-frequency monthly economic indicators, the data over the past few months shows that things like the tax collections, the two-wheeler demand, the air traffic passenger, and so on, are showing signs of an improvement. So clearly, the economy is recovering. We believe that's point number one. And point number two is that the investor expectations, especially the foreign investor expectations, have been moderated significantly. So when we started 2015, the foreigners were carrying pretty large overweight on India. I think the extent of overweight has got toned down over the last 12 months. And so to that extent, the expectations have moderated as well. So I think as a combination of these two and coupled with the fact that the valuations for the market as a whole and for most of the large cap stocks is in line with the historical averages, I think the valuations appear sustainable and the returns should be in line with the expected earnings growth of around 12 to 15%.
Do you think India is still the most overweighted market by foreign investors? It was in the beginning of 2015.
India is still the overweight market for sure. But as I said, the extent of overweight is significantly lower today than what it was 6 months or 12 months ago. We have done this analysis wherein we see that over the last 6 months, the multi-country funds have sold Indian equities to the extent of $6 to $7 billion or maybe a little more, and we've seen inflows on the India dedicated fund side. So yes, I mean if you look at India's weight in the overall emerging market funds, that has definitely come down.
Okay, the level of overweight has come down. Do you think the weight will go down more, Mahesh, or that's tough to say at this point?
I think the relative weighting of India is one point, but the other two important points, according to me, is that one is what is the extent of flows into the emerging market funds to start with. So, while we can debate about whether it should be 8% or 10% or whatever, but what is that 8 or 10 percentage point off is also a big question. And I think the kind of outflows that we saw last year, from the emerging market funds in general, should not repeat, I believe, in 2016 because it looks like the overall global market sentiment seems to be slightly better today than what it was a few months ago. So that is point number one. And point number two is when we talk about the foreign flows, we are seeing more inflows coming into country dedicated funds. So that's also an interesting point to note because for most part of 2012, 13 and also 14, we saw country dedicated funds not really seeing much of inflows or in fact seeing outflows. So that seems to have changed definitely.
Country dedicated funds though are much smaller in size, right? I mean, so they are seeing more inflows, but in the overall scheme of things, they are still very small.
That is true. Absolutely. But the inflows into the dedicated funds is proving to be a bit of a counterbalancing factor, at least in 2015, and I think that should probably continue.
Okay, fair enough. The other important source of funds is sovereign wealth funds. I mean, they have about $25-30 billion invested in India. Do you think that can be a problem, especially sovereign wealth funds out of oil-producing commodity, dependent economies, countries?
I think that is a very interesting question because, in fact, recently we did a pretty detailed analysis on that. And, while all of us feel very optimistic that the oil prices have come down and, which has like multiple positive impact on the Indian economy, but it can also work the other way around, as you rightly mentioned, the sovereign wealth funds, which, according to the SEBI data, has about $26 billion in India. As we speak, and that number hasn't really changed much over the last 1 year. The sovereign wealth funds, by the way, I must make clear, make their investments in two specific ways. One is that they're direct investments into different countries like India, and secondly, they also route their investments through external fund managers. With the likes of, let's say, like Fidelity or T. Rowe Price and so on. So what SEBI reports is the direct holdings of these sovereign wealth funds, which hasn't really changed. But my sense is that they have probably already withdrawn some money, through the external managers. But yes, to come back to the original point, we cannot rule out more such withdrawals going forward, and that is one thing that we clearly, need to keep in mind.
Do you think the reaction to the Fed hike that we saw mid-December is it? So this is the reaction, then it is great. I mean, it's been actually quite nice. The market in local rupee terms is up 6% more, 6.5-7% actually since the mid-December price. Or you think as more people come back, the year takes off in right earnest, we will see the real reaction coming through, and that might be different and in the opposite direction to the one that we've seen so far.
That's true. I think this whole action that the Fed have taken in the month of December was probably very well anticipated and very well debated, discussed, and so on. And in fact, I would say that it was eagerly awaited. And in fact, I would go to one more step and say that if the Fed hadn't raised the rates, then I think we probably would have seen some turmoil. But anyway, so now the expectations are clearly that there will be more rate hikes by the Fed over the next 12 months, possibly at the rate of 125 basis point rate hike every quarter. So that's what the consensus seems to be building in. So I would therefore say that the Fed rate hike is now pretty much expected and anticipated. The bigger risk, according to me, could come from the other part of the world and actually closer home, which is China. I would say that if you look at the various risks that we talk about to the global flows or the global economy, I would say that the potential depreciation or devaluation of the Chinese currency could be a much greater risk than the US Fed rate hiking.
The yuan, though, is depreciating as we speak, right? I mean, it's been set lower quite regularly.
It is happening. As of now, still the belief is that the currency depreciation of the Chinese yuan will be much more measured, much more controlled. The expectations is that of a 5 to 7% maybe on the outer side depreciation over the next 12 months. What will be the risk to the downside if that number turns out to be 10% or 15%? Then that is the real risk.
But that is not what your working case is, right, for 2016. Working assumption is.
That's not what the expectations are. That's clearly not the base case. I was just trying to highlight the risk to what the general assumptions are. I think the risks are coming more from the China side than from the US or Europe, is what I'm trying to say.
Mahesh, do you think The US will pose a big risk, not in terms of economy, but the stock market, which has done phenomenally well over the years. Many have tried to call the demise of the peak of the US market unsuccessfully as well. Do you think we'll see a meaningful correction in 2016? And that might play a significant drag on markets around the world, India included.
So, what we are, highlighting is, clearly, the fact is, one, the US dollar will be strengthening during 2016 and going forward. The emerging market currencies, including India, will see depreciation, and we are expecting about a similar 5 to 7% depreciation for the Indian currency, as well. So that is something that we are clearly highlighting. But other than that, we expect the US economy to actually show slightly upward moving trend in terms of the GDP growth going forward.
Okay, just to come back to my first point, do you think for Indian equities, given all these things that we discussed so far and other externalities as well, it'll be a better year than 2015?
Oh, certainly. I definitely believe so. 2015, as I said, we had like negative returns. 2016, I'm expecting 12 to 15% return from the equities. So as I said in the beginning, I already highlighted the two specific reasons as to why I think so. In addition to that, I would say that the other factors that will help the equities perform better would be, one, I expect the flows from the domestic investors to continue at similar pace of like $1 billion a month. That's the additional point. And I mean, I believe that the valuations for the large caps are at a pretty reasonable level. So the expectations are quite moderate as well. So the market returns is always a function of the delivery versus expectations, and the fact that the expectations are not really that high would be one of the reasons I believe the market should do better than 2015.
No, but in absolute sense then, Mahesh, you aren't expecting a strong year, in absolute sense, for earnings.
Yeah, so the thing is, one is expectations. The second is also the fact that the base for the earnings growth in 2016 or FY17 is actually quite low. So the low base will also be a helping factor. For the last 5 years now, we have seen the corporate earnings growth in the range of 5 to 7% on an average. We expect that number to be around 15%, for FY17. And that will be driven by, as I said, the base effect. A lot of large, index constituent companies have seen certain one-offs or write-offs during FY16, and that will help the reported earnings growth to be better. So yes, I mean, a part of this recovery is going to be optical, but it doesn't matter. I mean, once the headline numbers begin to show reasonably good improvement, I think the valuations typically follow, and I believe that the low base driving better reported earnings growth is not far away. In fact, in the December quarter itself, which just sort of went by, we will see some companies reporting good numbers for the December quarter itself. We will see those numbers coming out in the next 15 days to 45 days or so. So the reported numbers for December quarter itself will be better than what we've seen in September and June quarter.
Mahesh, do you think one of the big themes, maybe even the dominant theme in 2016 will once again be betting on beneficiaries of the commodity price decline across the board that we've seen?
Yes, and no. Yes, because that is like pretty obvious thing. The reason why I'm not that gung-ho on that as a theme is that in our coverage universe during FY16 we have seen a 350 basis point EBITDA margin expansion for the companies under coverage. So a large part of what you just said is there in the numbers already. I'm not saying that the margin improvement story is now a history. We still expect 100 basis point more margin improvement going into FY17. But as I said, that is lesser than the 350 number that we saw, in FY16. So my sense is that, going forward, we will see now only the residual and full year impact of the lower commodity prices. But the bigger driver for margin expansion going forward will be the companies or will be the sectors which would be able to show revenue growth improvement. And the operating leverage will be key to watch out for, because over the last 3 to 4 years, several fixed costs, including salaries and wages, as a percentage of revenue have gone up materially. In fact, the salary and wages part has gone up by 250 basis points of revenues over the last 3 years. So I think the source of margin expansion going forward is going to be more operating leverage than the continued commodity price corrections.
Yeah, no, fair enough. But are there, you think, drivers for that kind of demand pickup which will lead to companies realizing operating leverage benefits? Are there drivers that you see?
No, so as I said, I think the slow demand recovery or the slow process of demand recovery has already started, in my view. And which is visible, as I said, in some of these auto numbers and some of these other high frequency indicators, including power generation and so on. So I think some part of improvement is already visible, and my sense is that as we go ahead, this will slowly become bigger and broader. I'm talking about the recovery part here. So that clearly is our key thesis.
All right, fair enough. Where do you see the biggest play as far as realizing the operating leverage part is concerned? Which sectors?
I think the operating leverage, would be visible, according to me, in certain sector and stocks. So while I will not, get into the specifics, of the stocks, but at the sectoral level, I think one place where you will see this is probably IT sector, IT services sector. Clearly the wage inflation or wage cost is a pretty large part of the overall cost structure for the sector as a whole. And my sense is that in line with the inflation coming down, the nominal wage growth in general will also come down, and that I think will be most visible in the IT services space. And I think it'll have a beneficial impact on the margins and earnings growth going forward for that sector, because I believe that the revenue growth will remain pretty much intact. Now, while there is a noise around the US presidential elections, but the history tells us that this is a once in every 4-year kind of a phenomenon, and it doesn't really impact the business of IT companies, and the historical evidence suggests that the stocks also do not necessarily underperform the market. My sense is that this time it's going to be pretty similar. We are quite confident that the IT services as a sector will deliver at least a 15% or a little bit more than that earnings growth, in rupee terms, helped by both the operating leverage that I talked about and also the currency depreciation.
Fair enough. Which other areas are you most bullish on, Mahesh?
So IT services is one of our large overweights. Apart from that, the other large overweights for us, is private sector banks. Then we are also quite bullish on the four-wheeler space. So these are, I would say, the three significant, the most significant overweights for us, at the sectoral level. There are obviously certain other stocks which we like and run a large overweight on, but as I said, so those more due to the stock specific issues. But at the sectoral level, these three: IT services, private sector banks, and four-wheelers.
Okay, so if you actually had to buy only 3 stocks, Mahesh, theoretically, you'd buy names from these 3 areas, right?
Yeah, yeah.
Mahesh, thanks very much for joining us. Great speaking with you.